Okay, welcome everybody to episode 98, the Volatility Barometer podcast. So we are closing in on 100. Of course, it's going to be, I don't know what I'll plan, if anything, for 100. I know it is a little bit of a milestone, but, we'll see. Maybe something will come up. I see my sister reminding me that it's Valentine's Day. Yes, happy Valentine's Day to everybody out there. Hopefully you remembered. Who would forget Valentine's Day, right? That's unforgivable. Certainly not me. Certainly I didn't wake up this morning and completely forget that it was Valentine's Day. But in my defense, I did maybe 2 weeks ago book something. I booked a wine tasting and a nice dinner. I just happened to forget it was today. So, don't do that. Don't make that mistake. Hopefully, hopefully you didn't get into trouble. So anyway, thank you very much for joining. Today, just a little bit of housekeeping. Today is actually going to be a little bit different than our usual live streams, I think, where, typically we go for maybe 20 to 30 minutes. I will do something reasonably quick. I'll just find something, volatility ETFs, options trading, something interesting, do a little presentation, and then we'll do a really long Q&A afterwards. And sometimes they go for an hour, sometimes even 2 hours or longer. We've done over 3-hour live streams before where just answering every question that comes in. But today, to be honest, I want to do a really deep dive into Iron Condors today. And originally I was going to split it up into 3 parts. But the problem there is that when you do that, you come back next week for part 2. Some people haven't watched part 1 yet. And then by part 3, it's even worse. So I'm just going to try to get through this all in one live stream. So if you happen to get bored halfway through, I'll try to keep it interesting. I've got a million charts to show you. I think it's going to be very valuable. But if you happen to, you've got to duck out for any reason, it will be on the YouTube channel. So don't worry, you can come back over the weekend. I believe Monday is a holiday, so I think it's a three-day weekend, if I'm not mistaken. Can't remember what the holiday is. But yes, I believe. I'll have to check that for sure. But I won't be offended if you can't sit through the whole thing. I'll try to keep it fast. To be honest, most people ask me to slow things down, to speak slower. I think fast, I talk fast, and I'll try to slow it down, but we do have a lot to get to today. So without further ado, let's get into it. Okay, so like I said, we are going to do a full Iron Condor live stream today. And what I want to try to communicate to everybody by the end of this is if you are already trading Iron Condors, of course, regularly, that would be fantastic. Then great. Hopefully you can learn a few things, maybe streamline your systems. I've got a long set of rules that I'm going to get to, all of my entries and what delta do I choose, what strikes, what allocations. I'm going to get through all of that, and we are going to do a live trade example as well. But for anybody who doesn't really trade Iron Condors much or at all, I hope by the end of this I will have convinced you that pretty much everybody out there, I believe anyway, should have some Iron Condor allocation in their portfolio. So let me just pull up some stuff here, and we'll begin. So the first thing that I wanted to let everybody know, there is an Iron Condor course within VTS that I do think people will find valuable. So hopefully, internet seems a little slow. Hopefully everything's okay. But we do have a course library within VTS, and none of the courses are paid courses. These are all included. You subscribe to VTS and you get it. So I will go through some of these courses, but I just want to let everybody know, first of all, you can actually do this, technically for free. You don't have to pay anything at all. If you go to the subscribe channel on my website, and I would encourage everybody to do this for the next couple weeks, but if you'll notice here, it says that every subscription does receive a free 2-week trial. So you can sign up, you sign up right here, click to subscribe. You do get a free 2-week trial, and that will be plenty of time for you to make it through at least the Iron Condor course, but also get a good look at all the other things as well, because course library is quite extensive. We've got a tactical volatility. This is for volatility ETF traders. This is a 20-lesson course that you can go through. So pretty solid there. This is the Iron Condor course I'm talking about. This is actually 30 videos. So it's a very extensive course. I think I added it up. It's something like 5 hours. And it's edited tightly. It's not 5 hours of me on a live stream. It's literally 5 hours of edited videos inside there. So pretty extensive. This is a strategy that is currently not in our portfolio anymore. I actually removed it because it was slightly confusing to people. It's UVXY Broken Wing Butterflies. Wasn't super popular, even though I love it, but I left the course in the library, even though it's not included. And that's 16 lessons there. So if you are interested in UVXY trading and especially Broken Wing Butterflies, that's for you. Stock replacement, this is another one that is in the course right now. Very useful for people who have no access to US-based ETFs. You can actually trade US-based equities and ETFs through options. So you can do stock replacement. You can go through this full video course, 12 lessons there. And also sometimes even for people who are in the US, you may not have access to trading something like SVXY, for example. Sometimes just regulatory-wise, your broker might not allow it. Using VXX put options is definitely a good workaround there, and everybody will have access to that. It's just long put options. You can definitely get approval for that. There's many other courses. Some of them are done, some of them are not yet, but you get the point. There's a lot of courses there. So the end goal, I'm trying to get all of my strategies with a course. Right now, we've got 3 of them that have courses, but this is essentially our portfolio right now. Iron Condors is what we're going to focus on today, but I will be doing long, sort of extended live streams for the other 3 as well. But today's Iron Condors. Essentially, go in there, watch the video course, and if I'm being perfectly honest, to save you a little bit of more time, if you were to get through the first 10 videos, let's just go in here. This is the course. It looks like this. Break it down. If you were to go through the first 10 and then you watch the live trade example, I believe that's lesson 30 or something, you're probably going to be about half of the way there anyway, and that'll be good to get you started. So one of the cool things about the course structure as well that we do, it will save your progress. So you just start lesson 1, start watching them, and you can just pick up where you left off. You just push resume and it'll go there. So I'm going to go through these very, very quickly and sort of give you an idea for what we're talking about here. So lesson 1, no surprise, I believe this is the most important lesson. It is called Why Trade the VTS Iron Condor Strategy. So actually, before I do that, I just want to, just in case there's a few beginners out there, I know in my community, there's a pretty good chance everybody here knows what an Iron Condor is at this point. This is, like I said, live stream 98, and I've been managing VTS for over 13 years. So if you know me at all, I'm sure you know what an Iron Condor is. But just to be completely thorough, for anybody who doesn't, give me 1 minute on the clock. Where's my sheet here? That one there. Just give me 1 minute to explain what it actually is. So essentially what we're talking about here, just imagine that this is the stock market, this is the S&P 500. Of course, we can't see tomorrow. We have no idea what's going to happen tomorrow, next week, next month, right? None of us do. A lot of us pretend we do, but in the end, nobody really knows. The point of the Iron Condor is that you really don't have to know. You just have to know that whether it goes up or down, there is an opportunity for profit here. So that might sound too good to be true. There is a catch, of course, but the key to the Iron Condor is it can actually profit no matter what the market does going forward, up or down. Where essentially, if you imagine this is a price line, high prices over here, low prices here, we're trying to throw out a big net with an option strategy that's going to capture that middle ground. Now, the catch, like I said, is that if it deviates too far in either direction, then of course losses can be made. No strategy is perfect, but that's essentially what the Iron Condor is doing. And it is actually a 4-leg option spread. So on first glance, it might appear quite complex, but don't worry. It's one click. You just select Iron Condor. It builds it for you in your software. You just adjust the prices. It's very easy. Like I said, I'll do a live trade later on today. You'll see how easy it is. But an Iron Condor looks like this. You've got short puts and calls and then long puts and calls to cap the losses. And it creates an option spread that captures a nice profit range in the middle if the markets just chop around sideways, and then losses on either side. So if you flip that on its side, this is the little Iron Condor. Hopefully you can see the shape there. You can see that up or down, this is going to be just fine. We just don't want it to deviate too far in either direction. So the point is, like I said, and this is important to think about, that virtually no investors have anything in their portfolio that will profit if the markets chop around and stay flat. This is why I said I do believe that everybody needs an allocation of market neutral iron condors in their portfolio. Everybody has net long equities exposure. In fact, probably you have way too much of that. Strategies that do well in a bull market are a dime a dozen. We certainly don't need more of those. You'll see traders on Twitter talk about all the time, well, you just do this. You just buy leap options. You just, buy this strategy and maybe use double leverage and everything's going to be fine. This is recency bias. Of course, the market's done really well the last 5 years, but dime a dozen. Nobody really needs that. Strategies that are net negative the market are obviously not advisable because markets go up long term. So we do it strategically. We occasionally buy long volatility when we need to. But what you really want, because markets do actually spend quite a bit of time chopping around without any clear trend, you do want to fill that gap in your portfolio. So I would say, roughly speaking, I don't want to put a number on it, but there is a very, very good chance that you have plenty of net long equities exposure. And unless you are a sophisticated option trader, you probably have nothing that will profit in a flat market. That is essentially the point of the Iron Condor. It is to diversify a portfolio and to make sure that you've got something working for you when the market doesn't have any clear trends. So that would be lesson 1. That brings us back to lesson 1. The main reason you would trade Iron Condors is for what we would call correlation purposes. So if you watch that video, I will be talking about correlation. Now, correlation is essentially measuring the movement of one security in relation to another. So for example, this is all 4 strategies in our VTS portfolio, all the correlations. If you don't know how to use this matrix, you just find the strategy you're looking for, scroll across and compare it to anything else. So tactical volatility compared to the S&P 500, 37%. Now, what that number means, again, if you don't know, I'm sure some of you do, so just stick around for a few minutes. But correlation is measured basically -1 or -100% to +1 or +100%. Either way, sometimes you'll see it a decimal like 0.85. Sometimes you'll see it as a percentage, 85%. But correlations up here, like I said, dime a dozen. Most things are highly correlated to the stock market. But that would mean that when stock market goes up, the comparative security or strategy always goes up. If it's negatively correlated, like you're talking about long volatility, for example, that might be way over here, where if the market goes up, it always goes down, right? And then somewhere in the middle, that's really the holy grail of diversification, somewhere in this middle range, which is very difficult to do. And just giving an example of how hard this is to do, even portfolios that have plenty of other asset classes in them and different strategies, they are still highly correlated to the stock market. So VBanks, 60% stocks, 40% bonds. Correlation to the S&P is 97%. Basically, stock market minus a little bit of the volatility. All-weather, Ray Dalio portfolio, this has a lot of other assets in it, a lot of bonds, a lot of other things. So 63, that's extremely low. That's really, really hard to do. HFRI hedge fund index, a lot of people think hedge funds, well, sure, they must be totally uncorrelated to stocks because hedge funds, that's the point, right? Well, actually, no, they're 84% correlated to the stock market. Short vol, pretty decent here, 51. That's hard to do, but of course the return is garbage, so who cares? And then 50, 30, 20. This is stocks, bonds, gold. You'd think, okay, this must be quite low, right? 50% bonds and gold must level that out. Well, actually, no, it's still 80%. So that is a problem. Now, what I'm saying today, Iron Condors, market neutral Iron Condors, are not correlated to anything else that I do or the market itself. So you can see the correlations across here, -2, -10 to 2. This is no correlation to our other 3 strategies. So basically, the Iron Condor strategy stands alone in that respect. There is no correlation there. And then to the S&P 500, -1. Now, another thing to just mention here, negative correlation or zero correlation by itself is not difficult to get. You could pack a portfolio with enough long volatility and enough, gold and bonds. You could stack it with certain things and it would come back with a 0% correlation. That's not the key feature that I'm focusing on here. What I actually want to mention is it is low correlation, but it is also low correlation with a positive return. That's the key feature, right? Zero correlation, I could build any number of garbage portfolios that actually have no correlation, but that's not what we want, right? So we want something that has a positive return. And of course this does. It's done very well minus the last, 18 months or so. It's been struggling a little, basically flat for a year and a half, but it's been doing quite well before that, right? 13-year track record. These are all live trades taken within the VTS portfolio. And to get a 15% return during a bull market with no correlation to stocks, if you know enough about investing, I don't have to tell you how difficult, and not to big up my own strategy too much, but how special that is. It's actually extremely difficult to do that. So you'll see plenty of low correlation that has, like I showed you, 4 or 5% return, not even worth putting in your portfolio. You'll also see plenty of good returning strategies, massively correlated to the stock market. They're going to crash 40 or 50% when the stock market does. We're trying to get both of those at the same time and insert Iron Condors. That is actually what they thrive in. So correlations there. This is really the key feature of why this strategy stands out above the others. But I just want to rip through some of these other ones, just see if any titles jump out at me. You can check out the performance here. Remember, these are all videos. This is a good one. This is a spreadsheet. We'll actually go through this later, but it comes with a full spreadsheet so you can actually track everything. Every cell is explained to you, so you can just really take all the guesswork out. It's very easy. I'm going to go through this with the live trade and actually input the spreadsheet just to show you how easy and quick it is, but you can download that. I'll circle back to this one. This is what we're doing today. We're going to go through all of the rules of engagement. I'm going to show you exactly how I personally open them. Number 7, this is important if you don't understand the actual trade signals from my email. Some of this lingo sometimes is a little bit weird for people. Buy to open, what is a 17 April? What is allocate 3%? This is today's trade that we're going to enter. I sent this to the community already. And in the course, there is something that explains every one of those little lingo words and whatnot. Allocation size is huge. This confuses a lot of people, so I'm going to go through that. Execution. Allocating idle cash. This one's interesting. I do need to go through this for people who are wondering. You can see here it's a 25% allocation. Now, these are all ETF strategies, all 3 of those. So if you're buying an ETF, it's actually very easy to do, right? As far as how many shares do I buy, right? You just divide the capital you want to allocate by the share price, and that's how many shares you buy. Problem with Iron Condors is they're extremely capital efficient. So if you were to take 25% of your capital and open an Iron Condor, that would be an insanely huge position. And of course, if it worked out well, great, you'll make a lot of money. But the opposite could also be true. You could actually lose a lot of money. So because of the capital efficiency involved there, what we do is we allocate 3% of total asset value. So you just take your entire portfolio, 3% of that, and that's our portfolio. That's our Iron Condor size. Now that begs the question, because getting a little bit ahead of myself here, but you can see we have potential for as many as 3 layers. So that means there is at most 9% going to be used, but it says 25. Why is this? So there's actually 2 things I could do. The first thing I could do is I could literally make this 9, or let's say 10 for easy math, and then I could make these 3 30, and that would fill out the portfolio. And that would allow us 3 levels of Iron Condors. The problem is, this is short volatility, this is 2 times the Nasdaq, and this is the S&P 500 during aggressive times. They also rotate to safety, utilities, gold, long vol, cash, a bunch of different things. But 65% of the time, they are allocated to those positions. Now, as we know, and I'm certainly not going to blame this on Trump, but in the Trump era, I am expecting that, this is certainly not going to go away. Sometimes you just wake up and the market is down, right? Everything was going fine. You close, end of day, all your positions carry over. You wake up the next day. Trump has said he's going to slap tariffs on somebody or something. He's going to, just remove all the people from a piece of land and just build hotels on it. Whatever he's going to say, you just wake up and the market's down 2%. I think it's too risky to have 90% of my portfolio in positions that are going to be susceptible to that. Like I said, they do have full safety, but it is safety over 2 days and beyond. There is no safety overnight one day. There's just no way to avoid that. So what I have done instead is I've kept the 25% allocation, and the other 16% we just put in short-term fixed income. So we essentially use the SHV, 16% of capital. It makes 5% return because that matches up with short-term yields right now. You could use the SGov. That works just fine as well. You can see the shape of this. The price itself doesn't make any forward progress because they pay dividends. So every month they distribute some of that money and you get it into your account, but the price stays the same. The other option is something called box. You could basically buy this. It is a box strategy where they are able to capture the short-term fixed income yield while still keeping those profits within the fund and not distributing them in dividends. So if you don't care looking at dividends, you can do this one, or you could do the box. This one probably makes it way easier. And when I ran through the course the first time, I used SHV as the example. But to be honest, this is probably the default for most people. And I assure you they're all the same. So you could just pick whatever one you want. It doesn't matter. They're all going to get about 5% matching up with the short-term yields. But that's where 16% of the money is. And then the other 9% is in the Iron Condors. So I just thought I would circle that one and mention it because pretty important. Allocating idle cash. What else have we got? Stop losses are super important. I'll explain that later. Perform better in higher volatility. What is high volatility? A lot of these lessons are answering specific questions that you will definitely have when you start trading Iron Condors. I tried to think, put myself in the position of a newer trader. What are they wondering? Let's make a video on that subject. So longer dated contracts are better. You can go in and watch the video, 10 or 15 minutes, lots of examples in there. Wider wing Iron Condors are better than narrow wing. Also true. But I'm not the type of person that just wants to give you the final answer, just tell you, oh, wider wings, just do that. So I've made a video showing examples, comparing narrow versus wide and all the results. It's clear wider wing is better. ETFs versus indexes, calendars versus condors. You get this, should probably mention it as well. Iron Condors are called Vega negative trades, which means they are essentially short volatility. And calendars are Vega positive, which is basically long volatility. Now, if you know anything about calendars, they're basically the same thing as an Iron Condor as far as risk-reward profile. It's just that because there's a short strike and a long strike separated by different months, depending on the time frame you hold them, they can behave differently with respect to volatility. For us, we don't hold anything long-term, so Vega positive is for calendars. They can be Vega negative if you hold it to expiration, but we don't do that. So during mid to high volatility, we use Iron Condors. During low volatility, we use calendars. There's a couple lessons there that explains this sort of break threshold there. Allocation size, what else have we got? Diversifying into bonds and gold. This might be important for people. We do that. We do diversify a little bit into bonds and gold, but that's after equities. Performance, losing trades, larger trade size. Hopefully, whoever's watching this has a big account, $1 million account. When I send out trade signals, we're using the ETFs like SPY, Qs, IWM, TLT, GLD, things like this. But if you have a very large account size, you can go to the indexes. You can use SPX, NDX, RUT, things like that. And it will make it much more capital efficient for you. So that lesson is for all of you rich people. What else have we got? That's pretty much it. Watch the examples. So like I said, pretty extensive course there. I would venture a guess that you're not going to find anything like that, especially for free. I'm pretty sure of that. I put all my chips in the middle of the table that you're just not going to find that. So hopefully you take me up on my offer and check out that course that I put together. I did put a lot of work into it. So what I really want to do now is, as we narrow in on opening an actual live trade, like I said, I'm going to come back to this specific video. It's called Rules of Engagement. I'm going to go through the rules of engagement on how I trade Iron Condors. Just a checklist from 1 to 10, actually 11. I'm going to add a little one here. But top to bottom, these are the rules that we follow. So number 1, we trade highly liquid ETFs. Couple of reasons for this. First of all, like I said, with Iron Condors, where's that slide? We're looking for something that stays reasonably range bound. So you're not looking to trade biotech stocks here or anything like that. You're not looking to trade Tesla just before an earnings announcement. We're really looking for stable ETFs that track broad indexes. Like I said, S&P 500, Nasdaq, GLD is fine, things like that. Stocks, bonds, utilities, real estate, things like that. You can also check out an ETF list, and you want the open interest. You want highly liquid. That is one of the most important things when you're trading options. You need that. And the second reason would be just for efficiency, efficient fill prices. Iron Condors are 4-leg option spreads. And if you're trading non-liquid stuff or even partially liquid, you got to remember that liquidity is usually fine on the entry, but what you really want to be concerned about is, can you exit with good prices in a fast-moving market? The only way you're going to get that is if you stick to the highly liquid ETFs only. So this is rule number one. We don't break that. We almost always are trading the stock indexes, and occasionally we diversify into bonds or gold. Rule number two, Iron Condors during mid to high volatility, calendars during low volatility. Now, how do you divide this, right? How do you know what's mid, high, and low? For us, because I have a volatility barometer, it's kind of the centerpiece of my work, to be honest. The volatility barometer is comprised of many different volatility metrics, more than you see here, kind of all combined into one single number. So it's kind of a mess to look at over long term, but you can see divided down to the 3-year and 1 year. This is the volatility barometer. It is one single number giving me the best representation of what, in air quotes, you can't see me, volatility means. So today, 41.84. Volatility is in the low-ish 40th percentile. So not super low, but low. Now, when you're trading Iron Condors, you may not be a member of the VTS community. So if you are, use this. If you're not, there's a couple other choices. One of them is IV percentile. You can go into your trading software. Maybe I'll show you right now. I was going to say I'll show you later. So if you go in, this is just think or swim. You go into the Analyze tab. I'm sure if you trade with a different broker, you'll know where this is. But if you go into the Analyze tab, these are the option strings. If you go to the very bottom, it says today's option statistics. You can see it's actually 15. That's very low, current IV percentile. Now, the one problem with IV percentile, as you can imagine, is that it's tracked over 52 days. So it is a pretty good representation of where volatility is, but it can be a little deceiving. So for example, if you're in a year like this year, we have pretty high volatility, right? At least wild volatility. Here's the VIX. I mean, look at this. The VIX has had numerous large spikes. And in fact, I think I have a chart showing that. This is the top 25 largest VIX spikes going back to 1990. So what is that? 35 years of VIX index values. 3 of the largest 25 happened in the last 6 months. So you could certainly make a case that the last 6 months is as volatile as really the markets get, minus an extended recession like the financial crisis or something, the pandemic. But basically, really pronounced VIX spikes followed by, a short trend and then another spike, a short trend. So when you're doing IV percentile, what you see there, right? Like I said, 15 is low, but that's 15 in a very volatile year. So it's probably not super representative of what's going on, right? But in a pinch, if you're not in the VTS community, you can use that number as well. And then the third thing you could consider using, which it's okay. Some people just as a default, but the VIX index itself, right? So if you wanted to know, this is divided into deciles, 10th percentiles along the way. Long term, since 1986, of course, this would include the Black Monday in 1987. There it is right there. It went up to 150. So anybody who thinks the VIX caps out at 100 or something, no, it doesn't. It can go much higher. It went to 172 intraday on October 19th, 1987. So just a little side note. But the 30th percentile for the VIX index is 15.19. So you could basically use it as a proxy. You could say below 15, I'm going to use calendars. Above 15, I'm going to use Iron Condors. Pretty it's not great, but it's really going to get you in the right trade. Like I said, the risk-reward profile is pretty similar, so you're not going to go too far wrong. All right, number 3, we don't open new trades right at strong trend points. This one's a little bit tricky for people to understand, but bear with me here. So again, an example of a stock market, we're looking at it. Of course, you can't see what's going on forward, so this is one of those things that you're just going to know when you get more experience. But as the trend is getting stronger and stronger, if you see one of these periods where it's just basically going up every day for 2 or 3 weeks, you wouldn't want to open an Iron Condor there. What you really want to do is wait for a couple days of weakness and then jump into your trade. Because if you do get into an Iron Condor during super stable, strong trends, sometimes those reverse points can be pretty violent. So if the market's going up stable for 2 weeks straight, that first couple down days can be pretty violent. Same thing if the stock market is going down for an extended period of time and it's just ugly for a while, like, here, the snap upward when the market fixes itself and the news media says everything's okay and everybody jumps in and buys, those can be violent and you can get stopped out very quickly. So I just wait for a little bit of weakness just to get back to sort of the medium-term average, and then you would strike. So again, you'll know this when you see it. With more experience, you'll get really good at this, but you wouldn't want to do the inflection points, right? I mean, here is kind of fine. It would have been better to open one right there, but you get the point. That is one of our rules, that we don't open at strong trend points. Wait for a couple days of weakness, or reverse, wait for a couple days of strength, and then strike. Okay, so rule number 4, we target 45 to 75 days to expiration. This is essentially for safety. Long-dated contracts are safer. And for me personally, I'm always about safety. Capital preservation, number 1, chasing a better rate of return, number 2. But the reason that we want longer dated is because you can get those wings spread out a little bit wider, gives you a larger margin for error. And of course, I don't want to get too geeky today, talking about all the Greeks, but it also makes the trade less susceptible to single-day spikes. So, for example, if you had a 15-day Iron Condor or a 10-day Iron Condor open and the stock market moved 2%, you're in trouble. You're definitely getting stopped out. But if you had a 60-day Iron Condor and the same 2% happens, you're probably still okay, right? There's a lot of margin for error. The gamma's way lower. It moves much slower. And you're probably going to be okay. So it just allows you to stay in trades a little bit longer. So I would always recommend 45 to 75 days to expiration. The reason is for that, it's not any magical number. It's just I choose 60, like gun to my head, what is the best expiration? 60 days. So plus 15, minus 15, because of course we can only choose the option strings we're given, and you don't always get it exactly at 60. So you take what you get. But add a little, subtract a little. The reason 60 is the ideal is just because this is typically, out of the money options are a little bit different, but you can imagine that the decay path is faster the shorter dated it gets. This is why people are kind of enjoying zero DTE trading. I do as well. I do a lot of it. But, you get that massive theta decay on that one day if you catch a day where your strategy works out and nothing moves against you quickly. But around 30 days, it starts to drop off. And we don't hold trades past 30 days. So we're actually targeting somewhere in this range over here. Now, you might say, well, why not 200 days, right? Why not just extend it way out? Isn't that super safe? Well, yeah, it is. But then the trade doesn't decay very much. And you have to wait a long time and tying up a lot of capital waiting for that very slow decay to come into your account. So I think just the best of both worlds, safety and significant profit can still be made. Start around 60 days. And like I said, we are all subject to whatever option strings they give us. So plus 15, minus 15. The rule is 45 to 75 days to expiration. And I should note, for calendars, we don't open calendars much. Like I said, it's just for super low vol, but that would be the short month, just so you know. All right, rule number 5, we target 15 delta strikes on the put and call side. So this is fairly self-explanatory, but if you go into this one here, this is the delta column. I'm sure your trading software makes it clear as well. Get to know your deltas. This can basically be a proxy for probability. And all we simply do is we find something around 15 delta. you can actually see, oh, the market has changed a little bit since I opened that. But yeah, it's very easy to select something near the delta and then somewhere near an even numbered strike. All right, just to get the volume. You can see the open interest here. They tend on the 5s and 0s. Of course, they're going to be much better. So that's typically where we trade. Doesn't have to be. If you get closer to the money, you can get away with some odd numbers, but you can see it's a pretty significant liquidity difference. So just get something close to 15 delta, close to a 5 or a 0. And then on the call side, here's the delta here, something close to 15, something's, 5 or 0. You get the point. 15 delta trades on both sides. All right. Already talked about the 3%. Don't have to go through that yet. We allow for as many as 3 trades. Again, like I said, layering is always good. So not only is the Iron Condor strategy diversified within our portfolio, but the strategy itself is also diversified with 3 different positions, right? So stocks for sure level 1, possibly level 2 is usually stocks. If I were to do a third one, it would probably be bonds or gold. I would start looking at those as the diversification. So 3 positions open at the same time. Number 8, Iron Condors use a 50% stop loss, stop gain on every trade. Now, this one is actually really important to use stop losses. I'll use a trade that we actually have had open for a little while. So this is on the Qs. This is the Nasdaq. And you can see all Iron Condors, especially the way we do them with 15 deltas, the loss will always be much more than the gain. The potential loss will be much higher than the potential gain. People might look at that and say, well, why would I open a trade that can lose way more than it can make? And yes, valid point. But remember, we don't hold our trades very long. We are actually using 50% stop losses. So for me, this turquoise line, that's the expiration shape. But I don't care about the expiration shape because I'm not getting anywhere close to expiration. If you use a 50% stop loss and a stop gain based on the premium collected, then it means that all your Iron Condors are 50-50 risk reward. And then you just have to get more winners than losers. So that's one way to turn something that for a lot of people, they look at that and they think, well, that's not a very good trade. Actually, you can very easily turn it into a 50-50. Just use stops. The second reason you would want to use stops is just efficiency. You're tying up capital with every single trade. So Iron Condors, because they're vague and negative, if your trade goes well, you can get 50% profit out of that trade within maybe 3 weeks, give or take, something around there. So why would you wait another month and a half to get the other 50% when you're risking that trade turning on you and going against you eventually, when you can just take that capital, apply it to a new trade, get the theta decay there, take that one out at 50% and keep going. You're churning a higher number of trades and you've got less on the table, less risk on the table. So it's kind of a win-win situation. People who open Iron Condors and let them go to expiration, no, you'd be, again, to be too geeky, but I would say dancing on the gamma knife edge. Why would you leave capital tied up in a position that can only make the second half in such a long time? And of course, another month and a half, the market could do anything. It could go totally against you, and a 50% winning trade could quite easily turn into a loser. So we always use those stop losses. Number 9, we only add additional layers in the same expiration if it moves more than 4%. So essentially, basically said it. I started the trade right here. It hasn't moved much, but if it moves more than 4% in either direction, I could allow myself to open another layer, which would diversify this layer, right? Because it would be, let's say it went all the way over here. I open another one centered over here, and now I have a much wider range that I'm looking at. But you can only do that if it moves more than 4%. Otherwise, if I were to do it today, I'm basically doubling up on the same position, right? It wouldn't be a whole lot different than the first one, and no point in that. So that's one of the rules. The 4% rule doesn't come up much because, again, you'd have to abide by the 45 days as well. Actually, let me just check that just out of curiosity. I don't think it's 45 days today. So even if this did move more than 4%, if it was way over here, I still can't open a new one because the days to expiration violates a previous rule. So it doesn't come up very often. But if you wanted to layer it has to move significantly to layer. This is where I said I would add another one. We close all trades when they get inside 30 days. This is kind of a new thing. I don't like to let my trades go inside 30 days, so I will close them. Unfortunately, when I made the original video, unfortunately, you can't edit YouTube videos after the fact, but I had 10 rules. I should probably have had 11. But rule number 10, Iron Condors are traded independently of the rest of your portfolio. Another important key for my personal risk management. This might not be something other people believe in, but I strongly believe in this. Independent strategies. So I don't do anything in any of these strategies because something's happening in the other ones. I will never open an Iron Condor because this one is down, or maybe this one's down, and so I'll skew the Iron Condor a little bit to the high side just to make up for it. I don't do any of that. If my short vol is down, I don't open a little bit bigger SPY trade, none of that stuff. They are 4 independently traded strategies. They could function completely as standalone, or when you combine all 4 together, that's where you get the diversification. Now, it might not always work, right? You can run into environments, and I had my first one we launched in 2012. 2022 was rough for, well, probably everybody, but for me, because we did move to safety in those 3 positions. But unfortunately, in 2022, the safety positions were down just as much as stocks were, right? And some of them worse, like bonds were down almost 50% drawdown. When you're moving into safety to protect capital into gold, utilities, real estate, bonds, and those do just as bad as stocks, well, guess what happens? But fortunately, Iron Condors made 25% in 2022, and so it balanced things out a little bit. These were down more than 25, but this one was up 25, and so it wasn't a totally diabolical year. It was bad. I'm not happy, but it is what it is. But that's what independent strategies can do for you, because chances are pretty good that they're not all 4 going to fail in the same environment. I mean, knock wood, wouldn't want to see that happen. I mean, I suppose it could, but that's the point, is that usually you'll get 1 or 2 that are doing pretty well and it's going to insulate it. But the second you start making market predictions and saying, oh, well, I'm going to do this in this strategy to make up for the losses over there, and I'm going to double down on this one and average down because of this one, then it can go really badly. And that's how people get into these terrible drawdowns. And so I don't do that. Independent, standalone strategies put together in the same portfolio to really diversify things. So how long did that take? Look at this. Yeah, this is why I kind of wanted to divide it into 3 parts, but I do believe people will get value from this if you watch the rebroadcast. Trust me, most of our live streams are more fun than this. So if this is your first time here, please come back. You will enjoy the future ones more. Also, there aren't that many questions, so hopefully you guys are just riveted with the content and you're not asking questions. But yeah, you can go ahead and do that. Now, live trade. This is the important part. When you do a live trade, you can probably learn just as much about all the things that I covered as you could before. So like I said, if you do take me up on the free trial, definitely watch the first 10 videos and then go to video, I think it's video 30 or 31, less than 31. There's a full example there. You can do that, but let me give you another one. So what I'm going to do here, as you can see, I have already opened the trade because my official portfolio, you can see this is a live trade now. My official portfolio for VTS is always based on live fill prices from this trading account, based on a $25,000 model portfolio. So, wait, that's not it. SPY, this is the one. This is today's trade. And so I already opened it. I usually do my trades, after I send the email. But what I'm going to do now is I'm going to open another trade using the trade instructions, and I'm going to use this spreadsheet, which at least for the first few, I would encourage people to do. I think there's some positive benefits to learning how to use a spreadsheet and just input data. And another benefit is it will actually be super easy to calculate the number of contracts. So I left an example that I just traded in the past. What does this say? Recent live trade. It's not recent anymore. This course has been on for a year. January 18th, 2023. So this is just a trade that I opened at the time. And I left the example there so you can see it. But what I want to do is actually open this trade, right? So this is my daily email. It went out maybe an hour before the live stream started. You can see I make it very obvious at the top whether there's a new trade, so you can just see if you have anything to do that day. And then we get into the trading. So this is all the strategies just at a glance. You can see which one it is. I like to double and triple and quadruple up on all these things. So you might think, well, you already set it up top. I'll say it 4 times just to make sure people know what's going on. Volatility barometer. This strategy has been in short vol for a while. Nothing there. QLD Nasdaq for a while. SPY for a while. Nothing changed. This is the new trade. And typically I will say something about it as well in the blog section. Because today it's just an opening in the live stream, I didn't say anything. But let's go ahead and open this one using the spreadsheet. So I'm not gonna rush through this. I assure you, if you were to do this yourself, I'm sure you could get it done in 2 minutes. But I'm going to take a few minutes longer than that, I think, just to show people a few details. But don't be overwhelmed. I know when people see spreadsheets, their brain just shuts down. People hate them. They hate statistics classes from school. And, you know, it is what it is. You don't have to use the spreadsheet. I'm going to open the same trade afterwards and basically just do the in-your-head version. It's really easy once you do this a couple times. But let's use the spreadsheet. So you will actually copy Iron Condor, paste it there, and get started. So this is the 14th of February, 2025. We're doing SPY. I do a $25,000 model portfolio, but here you will input whatever value you have. So what is the open price of the SPY? This is where it's just, I should mention, anything in blue is an input sell. Anything in gray, you don't have to do anything. It's just a calculation. So you can see there's very few blues. Over here, this is for closing, so there's a gap there. You can see there's only about 10 or 12 cells here. This is not going to take long. But open the SPY, 609.45. So I will always record that. It's not overly meaningful, but 17th of April, 2025. There was 62 days to expiration. You can find that if you didn't know. You can find that here in the little brackets, 62. So that's there. What's the next input? VIX index. Again, not overly useful for this specific trade, but the reason I do that is if you want to compile and look at results later on, say you have 50 trades to compare, at that point you can start to see, oh, well, my Iron Condors seem to do better during high VIX or low VIX or whatever it is. If you have that data ahead of time, you know, later on down the road, if you want to actually start comparing things, it's good to have that data. It means nothing for this trade today, though. So IV percentile, and like I said, all of these are explained, so you don't have to just inherently know what you're doing. It's all listed here. So in Thinkorswim, go to today's option statistics. What did I say it was? I think I said it was 15, but let's just because it's late at night for me. Remember, I'm in Taiwan, so it's like 2 in the morning for me. 15%. Here we go. Volatility barometer. This, I think, is important, especially for compiling and comparing results later. 41.84. And then we just get to the trade. So you can go into the trade details, and it's a 570, 575, 640, 645. So you just do 575, 640, 645. We're almost done. And then when you build it in your software, I should do that again, right? I hate this thing. It's always in the way. So when you build this in your software, this is actually the trade right here. I'm going to delete this and build it again. So you'll just go into the simulated trades here. And you don't have to do this step. This is the Analyze tab. I'm going to build it first just so I can look at it. And then we're going to go into the Trade tab and actually do it. Later on, the In Your Head version, you will just, skip this step. But you'll just go down to anywhere on here. And this is what I said. It's a one-click transaction. So I'm just going to sell an Iron Condor. See? Analyze, sell, click Iron Condor, and it built all 4 legs for me. Now, these are not going to be right. None of these inputs are right, but we're going to go ahead and fix that. So it's this trade that is awfully narrow. So, of course, we don't want to open that one. The chances of success is basically 0 there. But we're going to do the 570, 575, 640, 645. So on the put side, we're going to do 575. You can see this doesn't take very long. And this step isn't necessary, remember. You could easily just skip this and do it all in your head. I'll do that in a minute. You'll see. It's not so hard. So right now it's paying $1.20. So you just put $1.20. Now here, this is very useful for people who don't want to calculate the number of contracts. Use the spreadsheet. It's done for you. So you can see all you do is you input a contract, and then we're looking for this number to be smaller than this number. This is our allocation size. This is our maximum loss. So if I put one contract, this is 380, this is 750. So I didn't use up my full allocation size. I could try to squeeze another contract, but now it's 760. So if you're a real stickler, like you just round down all the time down to the 2 decimal places, then you would do one contract. I'll kind of leave that up to you. For people who have smaller account sizes, like 25,000, sometimes you do have to do a little bit of, just use your judgment. What do you feel? Do you want to do 2, knowing that it's actually $10 too much? Does it matter to you? Because just in my brain, I always round down, I'll just go ahead and just do 1. But you could probably get away with doing 2. And then you can see we're done. That's really it for the spreadsheet. But there is some useful data here. Of course, I'll circle back to it, but it talks about stop losses and whatnot. So that's it. I can actually see the trade in front of me. It matches up to here. So this is the trade that I'm going to take. And now I'm going to just execute this. So now I'm going to go into the trade tab. Again, select Iron Condor, sell. It builds it for me. Make sure it's 1 contract or 2. Like I said, I wouldn't hold it against you if you want to spend $10 extra and get 2 contracts, but I'm going to be a real number stickler here, as I always am. 575, 570. This is, I don't know. I find trading pretty fun. The vast majority of my work is tedious spreadsheets and video editing. And so when I get a chance to do all this clicking stuff, like this is my video game. I know this is just a total side tangent, but I've told everybody I'm just strongly against video games. Of course, I haven't played games in decades, but this is my video game, trading, like doing the little geeky stuff, 0 DTE trading, Iron Condors, selling VXX put options. I would way rather dive into the trading software and start crunching numbers and doing trades than, sit there and play video games. Is this how people play video games still? I'm like 1985 Nintendo player here, so I have no idea what people do. But anyway, I find this enjoyable. So I was going to say, it looks tedious, but this is actually kind of fun. So here's the trade, $1.20. It's all inputted. Now, you could just click go. It's going to find the best price, but in the course, there is actually a lesson called trade execution and the 30-second rule. Now, what the 30-second rule is essentially you input a price slightly worse than you're expecting to get, and you wait 30 seconds. And then if you don't get it, you up it by the minimum increment, in this case, a penny, because we're trading the SPY here, and then you'd wait 30 seconds. And then you increase, wait 30 seconds. Typically, I say this for people because not all trading softwares visually will show you accurately. TOS is excellent, right? TOS really does show you very close to that midpoint. So it's a little bit less necessary for TOS users. But my long-term portfolio is at Interactive Brokers, and I can tell you that the bid-ask spread, as well as what it shows you the mid-price, there are times when it's wrong. So for other softwares out there, you might want to use your 30-second rule, because an Iron Condor is a 4-leg spread, and it will try to match up with computers the best available price possible. Even if you fat finger something, it will try to do the best it can. But if you give it that off-ramp of giving you a bad fill, you might actually get a bad fill. So you can see the mid-price 120. Let's do a super quick 30-second rule. It says 121 now. You could just go 122 and go. And it's going to go up here. It's going to go in working orders, and you're going to be able to see it. And then you wait your 30 seconds, and you see if it ticks up and you actually get your trade done. Now, I'm trying to get 122, and it says 120. I'm not going to get it, but just assume I waited 30 seconds. Move that. You can just hit cancel, replace, and drop it 1 penny. Keep moving that screen over, and go again. And see. Come on, ditch that. Go again. See if you get it. 121, 120.05. So, maybe this one ticks in, probably not, because it was most likely $1.20, but this is the 30-second rule. You don't have to rush. It's not a race. but you also don't have to wait around all day. Like I said, these are computers. It will happen quickly if it's available. So we got it for $1.20. So that's the spreadsheet version. I would recommend people do that because then you can just come back later on when you decide to close it. There's only 3 input cells. Remember, blue is for input, gray is a calculated already. This couldn't be easier, right? So let's say I close it in a month. You just put the closing price. Again, that doesn't affect anything here. It's just for future analysis. You really only need to input your closing premium. Hopefully, because it's $1.20, I can actually go to the stop loss part now. You can see the stop losses are calculated for you. So 60 cents and $1.80. Where is that coming from? Why are those the stops? Well, remember, we got $1.20 for this trade. So right here, we got $1.20 for this. So if that premium goes down to 60 cents right there, and I will just leave this open. Don't go delete this. It just makes it easier to look at tomorrow and next week and next month. I can just watch this. If this goes to 60, I'll take my profit. Remember, because it's a short vol trade, I want the premium to go down. If it goes to $1.80, that's 50% up. Well, if it goes to $1.80, I'm going to close it for a loss. That's my stop loss. So that's what I was saying. It's 50-50. I don't care that this turquoise line is lopsided and the loss is bigger than the gain. I'm only concerned with the 50-50 stops, and it's all actually calculated for you in the spreadsheet. Another thing that I did for the spreadsheet to make it real easy, I also calculated the dollar amount. So you can see $60 stop gain. What you can also do, now there's 2 contracts here, so I believe it's going to be $1, it's going to be more than that. Let me see. Let me do the quick math here. So you're looking for a stop gain target of 60 and 60. Well, it's actually $1.20. So instead of marking the break evens, you can actually just find your $1.20, somewhere around there. That's the high side stop. And then you can move this one to the low side stop, somewhere around $1.20. So those are actually the stop losses. And you can just come in every day. And if this trade is between those 2 hash lines, you leave it open. Or you look down here and it's $1.20. Remember, if it's below 60 close, if it's above $1.80 close, that's it. So like I said, I could have easily done that in 2 minutes, but I tried to go through just in case people need to walk through this and pause it. VTS community is getting into this trade today. So this is a live trade within our community. And there it is. You can go through that. Now, if you want to just bypass most of that, you can do most of this in your head. So what you do is you get your phone, you get a calculator out. All right. Get a calculator out. And all you do is you have to understand that the maximum loss for an Iron Condor is the maximum loss is what we're using as the break evens or as the multiplier here. Boy, I'm getting confused. Is it too late at night? So this is the trade that we opened. All you have to do, and this is going to look complicated, like I'm going to go through a bunch of slides here for the math, but trust me, this is literally 10 seconds in your head. I'll show you that. I'll prove that to you in a second, but I want to be thorough. So the formula is the maximum loss is the strike gap minus the premium you collected times 100. So you can see that 645, 640, there's a $5 difference there. 575, 570, again, a $5 difference. Doesn't matter which one you use, the strike gap is $5. The premium I collected is $1.20. So all you do is take $5 minus $1.20. So like I said, if you want to just watch, I'm literally, I would do it in my head, but if you wanted to just do 5 minus $1.20, oh, it's $3.80. Okay, there you go. So that's the first piece of information you need to do this super quickly. The second piece you need is 3% allocation, right? So the maximum loss is $380 per contract. So let's say you do have a $25,000 account. Remember what I said, we take 3% of that. So all we are going to do is take 3% of $25,000, which is $750, and divide by that 380. That's your number. So again, you can look at my dumb face when I do this. I know in my head that 25,000 divided by 3% or times 3% is 750. So you just take $750 divided by 380. That's it. That's really it. And then you can decide, of course, if you want to round up or round down. Is it important to you that it's exactly? I don't know. 1.97 isn't quite. So you can say I said round down to 1. But, again, I'll leave it up to you. And that's it. So if you had a $100,000 portfolio, what do? Well, we know the maximum loss is $380 per contract. So all we do is take 3% of our money. In this case, it's $3,000 divided by that same $380. It's 7.89. So again, I would round down to 7 if this was me trading. If you want to go up to 8, it's fine. But 7.89 goes to 7 contracts. That is it. So when you see the trade instructions, might look complicated. You think, oh, there's a spreadsheet, I have to do all this stuff. Not really. You can just do, strike gap minus premium divided by how much you're spending. And in seconds, you can do this. So then you would just go in and you would end. Like I said, you can just, wait, I didn't do screen share. Like I said, I always like to look at the picture, and I would still recommend you do this just so you can keep the trade down here. Build the picture like I did before. You just do that, adjust your strikes, and then just go right into the trade and do that. And should I open another one just for the hell of it? I don't know why I would. Let's do that. So again, you would just go to the trade tab. You would select sell Iron Condor, check its 1 contract. Again, that's going to scale depending on what you're doing. But let's do 575, 570. Fun stuff, right? Come on. Who doesn't want to be a trader? What is it? 640, 645? That sounds right. You should definitely check. You shouldn't just say, oh, that sounds right. So 119? Yeah, let's try for 119. So 30-second rule, it's going to go up into the queue, and I got it. I could have done 120, but I wouldn't have got it. 119, good to go. So that's it. That's how you trade Iron Condors. What I really wanted to touch on today, more important than just this trade example, was just the absolute, in my opinion, the extreme importance of having strategies in your portfolio that are not correlated to the stock market. Very few people have this. And if you're honest, probably most of you watching right now don't have that. Now, one thing I touched on before that I will, just for being thorough, mention again. Remember I said I personally do 9% and then 16% in fixed income? If you are a person watching this and you're in the VTS community and you actually do have multiple different strategies in your portfolio and you're sure that they have no correlation to the stock market, you're sure that they're good strategies, at that point, instead of the 16% fixed income, you could just bypass that and just substitute your strategy in that place. But again, this is why I'm stressing it that you're sure, because a lot of people just think, well, no, this is what's going to happen. The stock market does this. I'm going to swoop over there and I'm going to buy this safety position and I'm going to avoid all this trouble. And then when that's over and Trump says it's all green light, I'm going to go back into the stocks and I'm going to rocket it to the moon. They have all these ideas, whatever it is. But you actually have to run the numbers, right? So feel free to email me, send me your numbers, your monthly results. I will let you know if the correlations are adequate enough to sort of substitute for that fixed income position if you're an active trader. If you're not, which to be honest, our community is people who just, they pay me money because they like to just be told, hey, this is a good portfolio, I should follow that one. And they're not going to be building their own strategies and whatnot. Just do what I said. 16% fixed income is a very, very good way to just reduce the allocation size on those big hit days, because they will happen, right? Sometimes you just wake up and for no reason at all, the market is down and can't see it coming, right? And then you're just sitting there in the pre-market. You can see the futures are down, but there's nothing you can really do. You know when it opens, it's going to be a bloodbath. That happens. It's just part of the strategy, part of the process. All right. So how about that? How about the Q&A? We don't have a whole lot of time for this Q&A, but next week, I promise we'll do it either very short or just all Q&A, and you can ask me anything you want. I always throw this up if you want to chat about off-topic stuff as well. Some people just like to come and hang out and have a place to talk about stocks or, like I said, travel. I'm in Taiwan right now, but I'm also live in Dubai. I'm a golfer. What else did I put out there? Running, weightlifting. I'm into that. UFC, huge UFC fan, boxing fan. Yachting liveaboard, kind of a dream of mine. And my wife, sommelier that she is, I am trying my best to learn wine as well. All right. Very few questions. So I think you guys were all just glued to the unbelievable presentation that I did, right? At least in my head, I think that's how it went down. Otherwise, maybe everybody just left and there's nobody here. I don't know which one it is. But actually, you know what? Please, I always forget to say this, but we actually passed 30,000 subscribers and we're still going. And we're actually building and growing pretty quickly for, on my part, not a whole lot of public videos, to be honest. As you know, all my spare time is going into editing my VTS Options course. I'm building a full options course, and the public YouTube channel has taken a hit. But people are still finding it and subscribing, so all good. Please subscribe. Please give the video a like for me. Helps a ton, especially the subscribe, because I do have thoughts and plans in the future to start doing interviews. And of course, the more subscribers you have, the more engagement you get, the better guests that you can actually book. So help out the VTS community. If you want to see better guests come on and maybe watch me have a chat with some of these people, let's encourage them that we're on the map, right? Put us on the map with 50,000 subscribers. That'll be a good number. People will be impressed by that, hopefully. Not really, but it's better than nothing. All right, President's Day weekend. Yes, so next Monday, I was right in saying next Monday is a holiday. President's Day. Markets close U.S. on Monday. Thank you. Yes. What is this? Why is that so small? I swear, every day, I got a new computer, I got a new MacBook, not recently, but maybe 3 weeks ago. And for some reason, it's just not saving. So can you see that now? Let's get off this stupid. Can everybody see that? Is that big enough? It doesn't save it, so every time I have to make it bigger. All right. What is Louis Real Day? I have no idea what that means. My sister's telling me there's some type of... I'm so not Canadian. I have no idea what our holidays are called. If you ask me when Canadian Thanksgiving is, I have no idea. I don't have a clue. Yeah, I'm an embarrassment of a Canadian, so don't know what that means. I'll look it up, though. All right, do you think it's possible to trade VXX VIX spread? Example, on December 18th, going long VXX, buying the ETF. And short VIX index options for 1 to 3 days. Also, why don't your strategies involve looking at percent change of the VXX, VIX futures, contango, etc. from yesterday to today to determine entry and exit? Why do you rather solely use the current contango value instead of changes in such spreads? There's another one here. I'm going to keep going with your, I see a third one. I know you use other values than just contango for your strategies. I mean that you rather use current values than changes. So this is probably, I wouldn't say my fault. It's just the way that I do things. I don't share my secret recipe of my strategies. But yeah, I use a lot of momentum indicators. I just haven't, like, in my email, I have not shown everything, right? The reason that I chose these metrics to get people going, and apologies, it's been quite a while since I've updated and added new ones. So maybe after the options course launches, I could actually dive in and start doing more videos specific to this stuff. That was the original intention. But I launched this stuff back when we had the options community going. I didn't know that the community would grow and the emails burden would get so bad that I would have to shut down the options community or literally, shoot myself. It was just getting overwhelming. And so I basically just stopped here. But I think it would be, not really a mistake, but it would be wrong to assume that I'm just using like static values like you see here. It's not so much. In fact, the cash VIX oscillator is absolutely a momentum indicator. I just haven't shown you the formula and how I calculate that day to day. But it's a fair point. based on what you see in the email, you might assume that that's what I'm doing, that I'm somehow just using the daily value of contango. But I assure you it is much, much more involved than that. In fact, the daily snapshot value of contango, I would say factors in 5 to 10% of the actual trade decisions. It's really not something I'm looking at very much, to be honest. But yeah, maybe, this is a fair criticism. I have not had the time to really continue on that path that was intended back then. Went one direction, and then something happened. The emails were like 6 hours a day. I had to stop something. So I stopped this. I stopped, the options. And now I'm just getting my feet underneath me. The course is, I can see the light at the end of the tunnel. So let's get back to your first question. Do you think it's possible to trade? I mean, first of all, I'll say yes. Just blanket yes. It's always possible to make everything work, right? So what you're talking about here, sure. You haven't given me any details, so I don't know if you get the ratios right. You have to remember that these are not just mirror images of each other. Whenever you're dealing with any type of pairs where you're doing a long short or you're doing something over here and you're offsetting it with something else, you have to be very careful with things like that because they don't move with a one-to-one correlation, right? The beta factor between them is not going to be 1, right? So, yes, you could say that the VIX options is technically settling to the VIX futures and that's related to the VXX. I get where you're going with this, but to me, it looks like complication for the sake of complication, and especially 1 to 3 days. There's really nothing you can do in the short vol world over 1 to 3 days because the whole edge, the entire reason why this works is the built-in structural decay, right? But if you don't give it any time, like if you're day trading the VXX, you are just trading stocks. There's nothing volatility related in day trading VXX. You're just trading directional stocks. That's it. It may be called VXX and it may be a volatility ETF, but there's no time. There's no decay. There's no predictive value there. You are just saying binary up, down, and that's all we're doing. So 1 to 3 days for anything volatility market related is going to be an issue, right? When you eventually do see my 0 DTE strategies, you'll notice that very little of this volatility stuff enters the equation because there just isn't any time, right? The cash VIX oscillator is a momentum indicator over 7 days, waiting certain days. Well, if I'm day trading, there's no purpose to that metric. So yeah, I would say you've lost me. I'm not saying you can't short-term trade, but you kind of lost me there. I don't do anything related to this stuff. And I certainly don't pairs trade VIX to the VXX because the VIX is based on S&P 500 options, VXX, and then the VIX options settle to futures. And you're messing with betas that can react differently in different market environments. Why not just keep it to one simple thing and try to perfect that? That's what I would say. But again, not much information there. So this might be genius. You just didn't explain it. But yeah, you can make anything work. There's many, many ways to make money. My way is not the only way. What happened to the hold 1 Bitcoin, trade 1 Bitcoin comparison you decided to do? Yeah, I'm still doing it. I still hold one and one is in cash. I sold my last one at 95,500. And what is Bitcoin today? It's basically hovering right around that range, isn't it? Somewhere, it's up 3% today, 98,000. So I'm sitting on 1 Bitcoin that I'm just never going to touch, and 1 Bitcoin of cash value that I last cashed out at 95,000. And essentially, I'm trying to see if I can actively trade 1 Bitcoin just in and out and do better than buy and hold 1 Bitcoin. And so far, so good. I'm slightly ahead with my active trading. But Bitcoin is not something that I do have a Bitcoin strategy that is similar to my tactical strategies. I just haven't decided what to do with it yet. Because as I kind of alluded to before, we already have plenty in the portfolio that's going to do well when stocks do well. And I don't know what they think Bitcoin is, but I'm just telling you point blank, Bitcoin is nothing more than leveraged tech stocks. That's all it is. It's the correlation is unbelievably close to leveraged stocks. So where am I going to put it in my portfolio? It looks great on the strategy, and I've been trading it live. I've been using the GBTC, the grayscale. Works fine, but where am I going to put it, right? Nobody, like I said, dime a dozen strategies. Nobody needs more stock market exposure. We've got millions of people who can make money when stocks go up, right? As they say, everybody's a genius in a bull market. So that's where I'm at with it. I'll probably cover it. I mean, not today. I took up everybody's time, but I'll circle around. I'll let everybody know when I'm ready to buy another Bitcoin. All right. Is there any risk of QLD crashing due to how it's structured? No, QLD is not a volatility product. The reason the XIV crashed was because it has to go out into the open market and buy futures. And those futures had a liquidity crisis at the end of the day and became unbelievably expensive to buy. And so that's what happened to the XIV. No, the QLD is basically just, tracking the index. There's almost no variation between the SPY and the SPY index, the Nasdaq and the Nasdaq index, the Nasdaq ETF. They function perfectly fine. There's no risk there. Nothing to worry about. I'm assuming with the elevated volatility in the last few months, you are not doing butterflies on VXX. I am, yeah. If not, what are you doing with VXX, if anything? So what am I doing with VXX? I look at VXX and UVXY as the same thing, even though 1.5 times leverage to 1 times, it's the same thing, right? It's literally the same underlying. So when you say, what am I doing with VXX? Let's assume you also mean, what am I doing with both of them? So I still do trade the butterflies on my own, 1 to 2 positions. I try to roll them. I still love those butterflies. It's just the community didn't, right? Either my fault, I didn't explain them well enough, or people just don't like option trading. It just had an unbelievable number of emails of people telling me that this is, I don't like this strategy. What do I do? How do I replace it? What should I put instead? Like, wow, there's, hundreds of people that seem to hate this thing. So let's remove it. But I still do that. And then, of course, I do my Wheel of Fun, which is typically on both of them. I use 2 allocations, VXX, UVXY, that is selling put options, basically weekly, about 6 to 9 days, something like that. Weekly sales of put options. When I get assigned, I turn over, sell the covered calls, get rid of the position, rinse, repeat over and over. I do what I call the volatility step, which is more vertical spreads on VXX and UVXY, basically 3 weeks to a month, tracking forward, basically just trying to get a whole bunch of wins when it's trending, and then you can get a couple of losses when it changes direction, but that's called volatility step. I do that one. I do lots of stuff. Yeah, I'm always trading. Like I said, this is kind of my video game. It's just, I discussed this, I think last week or the week before, but it's actually pretty difficult to build a portfolio. A lot of times the easier part, it's not easy to build strategies, but it's easier to build a strategy than to find a place for that strategy in a portfolio. That's really the value add, is how do you put them all together and make sure that the correlations match up? And, when one has a weakness, where is it going to be recovered? Where's the strength? That's the hard part. And so I do trade, 10 or 15 strategies pretty much constantly. But whether they make it into the starting 4 strategies or not, that's another question. Like I said, I've got a Bitcoin strategy that I really like, but it's not better than defensive rotation. So it didn't make the starting 4. But yeah, I'm doing tons of stuff. And of course, when VIX Options launches, I'll be able to share more of that. For finding the best bid ask, choosing the best time of day is important. Opening of the market is best liquidity, but it depends of the market. So I would say, and this is something I talk about a lot actually, I don't have any data that shows any specific time of day is better for trading than any other, to be perfectly honest. I do think it's a random walk. I don't think people can say 12 noon is better than 3:30 or end of day is better than, 10 in the morning. It's all 50-50. There will be some days you take a trade, you get the worst price that day. And then there'll be other days that you get a really good price and then the market falls off after that, something like that. It should average out. The only thing that I will say is that there's no doubt the first 30 minutes are the most volatile. So if you're trading the type of strategy that is looking for that volatility, maybe an elevated volatility risk premium, for just top of my head, I trade multiple 0 DTE strategies. I have one that enters the market within the first 5 minutes because I'm actually looking for that elevated volatility risk premium. And then the strategy is basically hoping that it starts volatile and then kind of just pins the rest of the day. And I have other strategies that wait until around lunchtime before they enter the position, when there's usually a volatility lull in the market. And those strategies are looking for those entries when volatility is maybe relatively low throughout the day. So you can certainly say that certain times of day have different levels of volatility, but I don't think that you can say, well, although you're talking about liquidity, you're not talking about pricing. But anyway, I was going on the price direction. I don't think you can say that any time of day is better price. I have no reason to believe that's true. And I can see now you didn't actually say that. So liquidity, yeah, I would say same thing. Liquidity might pick up, again, there's a lull around noon, 1 o'clock, 2 o'clock, and then you imagine institutional traders, maybe they were at lunch in New York, they'll get back to their desk in the afternoon, maybe place some more trades, so liquidity might pick up in the early afternoon. That's something. But as far as pricing, I wouldn't look for any of that. Other than 0 DTE trading, I tend to avoid the first 45 minutes to an hour. Just not for me. Let the day traders play with that. Off topic, any thoughts on visiting Dubai for New Year's? I've done 2. I've lived in Dubai for 3 years, 3.5. 2 of them I was there for New Year's. So one of them we did Atlantis Hotel. It was awesome. And then what did we do the other one? I'm drawing a blank, but we did something else really cool. Yeah. I mean, my live streams oftentimes tend to be like a tourism advertisement for Dubai or something. I just love it so much there. I think it's great. It's the city of the future, as I always say. So I can't say enough nice things about how fun it is and how interesting it is. Yeah, New Year's in Dubai is awesome. So I like the buffets. I like to eat healthy for like 3 to 4 days, work out really hard, make sure I do my long distance runs leading up to it. And then New Year's, hit the saffron buffet and just destroy that thing. So that's my style. And then enjoy New Year's. And then first, no matter how hungover I am, no matter what happened the night before, I'm in the gym January 1st every single year, just to tell my brain that, okay, this is going to be a good year, discipline. So yeah, that's my style. But yeah, saffron buffet and then an after party somewhere. Not much better than Dubai. At least I haven't seen it. When you short Iron Condor, do you delta hedge as well? Or you bite the bullet when market becomes dangerous? It's not bite the bullet. It is just simply follow the stop losses and exit in a timely manner. So there's another video you will definitely be interested in watching. Let me get the title for you. Again, I don't like to just tell people, here's the answer, right? I like to actually go through the numbers. That's why I make all these videos. But lesson 25, we don't make adjustments to rescue losing trades. You will want to watch that video because what a lot of people talk about is either delta hedging or they will, when it gets into trouble, you sell this side, you double up on the vertical on the other side, and you try to salvage the trades. I've gone through the math and the numbers, and while there are ways to salvage trades, the best way to salvage a trade is to just close it at the stop loss and open a new trade and just layer more trades like that. That is the best. The way that I always view it is I am my own risk manager. I don't let the market push me around. I have my plan and I do what I do. If the market has other ideas and it pushes me in a certain direction, I'm not going to sell a vertical just because I'm in a losing position. To me, that's like averaging down. I don't average down just because the market moved against me. That is allowing the market to push me into a position that I wouldn't normally buy, right? If I was in just straight up cash that day that the market crashed, would I open just one vertical? No, of course not. I would open something good, a new Iron Condor I would open. if I was in full cash. So why, just because I'm in an Iron Condor, well, now I don't open a new trade, I open some vertical that I wouldn't normally have opened. No, I always make the assumption I am in fresh 100% cash. What's the best trade today? And the truth is that if you look at the market through that lens, you will probably never average down. You will probably never try to salvage Iron Condors. You'll probably never sell one vertical and move it over and drop this one down and sell another vertical. You won't do those things because you'll realize mentally you're just doing that because the market went against you. You're not doing that because that's the best trade today. So that's how I look at it. And I wouldn't say bite the bullet. I would say take my loss. We have plenty of losing trades. It happens. Any guess on the options course date and price range? You know it's been getting pushed back. It's just I'm overwhelmed with it. I have so much other work to do that it's just very little time to dedicate. And if I say something now, people are going to try to hold me to it, but I'll give you something. My brain feels like June 1st might be a good launch day. Now that it's out there in the ether, I don't know. I might get punished for that, but it feels like I'm just a few months away. Lot of editing at this point. It's basically just any spare time I have, get an hour free here, 2 hours there, just editing. Like I said, I shouldn't have highlighted that. I've seen other courses. I've seen other people's presentations. I've seen other people's work. I'm not trashing on them, but what it typically is, most courses out there is just somebody turning on a webinar or a live stream and just, fumbling through it with the ums and the ahs and here. And, you can watch for an hour and a half and they really only covered maybe 2 subjects. My course will be like the Iron Condor one. It's just super focused and edited right down. So it might be 10 hours of content, but it's 10 hours of dedicated content rather than I've got 20 live streams you can tune in. I do live streams for free every week. That's not special. I'm not selling my live streams. They're totally free. I don't sell my videos. It has to be good. So for me, it has been pushed back because I'm only going to release it if I am proud of it. And in order to be proud of it, I have to make sure that I do it right. So apologies, it's a little slow. I don't know if I should say this, but I don't actually have to do it at all. This is just something that I want to do. And I have to make sure it's good. There's no way I'm going to charge money for something that I could put it together in a month. I could explain everything half-ass in a month. I don't want that. Tell me some tips to look to start zero DTE. Start Iron Condor. Well, I guess the starting position, should I do it now? My camera's going to die. Any second now, I think that the image is just going to turn off, isn't it? How long have we been going? Okay, I'm going to risk it. I'll get you going because probably there's nobody watching anymore. We're an hour and a half in. Let me just think, what would be a good starting position? Well, I already know you've already started, so what I say is just going to be redundant for you. But what you could, again, it's going to be in the course, and I probably will do something like you're saying here. If you've never traded zero DTE options, learn this basic strategy. It probably won't make much money, but it probably won't lose much either, and it'll get you trading. It'll get you in there every single day actually trading. So what would I say is the baseline? So if you were to do something like XSP, and you were to go in, XSP just being the mini futures, just for people who want to get in and not spend any money and do something that they're not going to lose a whole lot of money. Zero DTE, what time is it today? It's 2:30. It's probably too late to do this. You'd want to give yourself 5-ish hours, and you might want to do 2 or 3 of them every 30 minutes. But I guess the standard go-to to just get somebody started would be, pricing's going to be really bad right now because, again, like it's a little bit late in the day to be doing this. But verticals can never go wrong with this. So 609, 607. See, this should be about I mean, $2 out of the money should be much better than that. So it should be about 25 cents if you were to do this like 3-4 hours ago. So now I'm going to have to go to the 610. This is going to be just a little sliver. This is not going to be good. But we use stops and everything. So 13, it should be 30 cents, 25 to 30 cents, something like that. And then you'd go on the other side. Let's see how bad these pricing is. I would never, ever do it this late in the day. So just to be totally, totally clear, 2 cents. 11.11. So let's just assume both of these say 30. I can't even do this on a live stream because there's just no time left. But again, this gets to the point that I was talking about. You don't look at the shape of the expiration because you're always going to be using stops. So let's say that this was 30 and this was 30, something like that, right? And here's the price in the middle. Now, then what you would do after you execute, you would go in and you would put a stop loss on both of these. So 30 cents, maybe you put the stop loss at like 90 cents, say, something like that, on both of them. And then you understand what's happening here. If the market stays in the middle, which, you know, a point or two here and there, it happens, maybe 30% of the time or something, you might get a win on both sides. That's great. You win both of them. But if you get a trending market, because you're doing a vertical and you're using stops, you can only lose on one of the two, right? If you lose on the other one, then you win on this one. And then the only time that you can lose on both is if you get a whipsaw environment where maybe it goes up here the first hour, stops out, and then reverses, goes back the other way and stops the other one out. Then you can get a double stop out. So essentially you have 3 possibilities here. You've got a win, market stays relatively calm, it doesn't breach the 90 cents stop loss on either side, you're good to go. That should happen more often, much more often than the super whipsaw one. And then a lot of days you're just going to have 1 win, 1 loss. And so this is why I said, just as an entry strategy, just doing a vertical on one side with a stop, doing a vertical on the other side with a stop, this isn't going to make a whole lot of money because there's no actual edge there aside from a decaying volatility risk premium over 5 hours, right? There isn't a whole lot of edge there. But it would get people trading and you'd be able to take trades every day. So maybe you do that at 11 a.m. and then you do another one at 11:30. Be very careful not to close out the previous one. So if you run out of strikes, then of course go to the SPX. It's a larger dollar, but go to the SPX. And this is the type of thing that a lot of people start with that I would say you're probably not going to get in a whole lot of trouble, right? As an entry trade, that would be something to look at. Another thing that I like to do, I wonder if I could do one now. It's just very little time left. I don't trade this time of day. Another thing that I like to do is I like to just do a butterfly and just fade the direction. So a lot of you watching, or if there's anybody watching this late in the stream, some people like to think, we all like to think that we're very good at predicting the market, right? We're like, I know which direction the market's going to go. These day traders, they think over a 1 day or a 2 hour period, they know which direction the market's going to go. Okay, better than 50-50? All right, well, one thing that you could consider doing, again, this is not trade recommendation, but let's say the price right now is exactly 112. Pick a direction. Right? I don't have much time left. I think there's only 2 hours left in the market, but let's say I had 5 hours and I pick a direction. Which way do I think it's going to go? You could do this 252 times a year. So let's say today I decided I think late in the day it's going to fade a little bit. You could just do a butterfly. You could expand the wings a little bit to give yourself a little bit more room. Remember, the price is right here. So I am basically paying 96 for the bet that I'm going to be right, that it's going to be down more likely than up, assuming I have a reason in my head to think that, right? Remember, we're just trying to 50-50 this. This is something that I do just for fun, just to track it over time. I have been doing these like daily, like I said. There's roughly 252 trading days in a year. You could just fade them like that. You could also break wings, right? That's a little bit interesting. So if you felt like, well, I'm pretty sure it's going to go down, but I mean, obviously I might be wrong. If you do a broken wing butterfly, well, now if you're wrong, you don't lose very much at all. And the only way you lose is if you're super right? I thought it would go down, but it really went down. Then I actually lose money. But just doing, this is what I would call a directional fly strategy. Directional flies are always really good. Broken wing butterflies to make sure that when you're wrong, because we're wrong all the time, that you don't pay as much for that. So I would say just broken wing butterflies. Again, you're not going to get into a whole lot of trouble, especially if you trade XSP. And then what you would want to do as you're building your knowledge base, you go into these baseline strategies where it's very likely not going to cost you a whole lot. Like there's really no avenue there to get in trouble. And then every day, every week, you sort of add new things and you start to see little patterns. You think, well, I'm starting to notice that if the market is down early in the day, volatility will no doubt be elevated. And I'm getting a little bit wider wings on my verticals. And so my stops should be a certain range, or little patterns that you start to notice, little edges. Over a 1 day or 5 hours, the available edges are very, very little. So you're looking for things like if the market opens up slightly, what does that mean? What are the better trades that day? I also have, I'm not going to share it here because I actually think it's a really good strategy. I'm making a lot of money doing it. But I call it the Trump hedge. I'll tease, because you kind of know what you're doing. You've been doing this for a while. My Trump hedge with calendars is a really fun strategy. Essentially betting on the fact that today might be stable, but tomorrow might not be, if that's a good hint for you. But yeah, I would say there's like 3 or 4 baseline strategies that you won't get into any trouble. And you can just dive in there and have fun. So it's just one of the problems that we will suffer. I tend to use the SPX, but I don't use the NDX. And, it's high dollar, so you can't do a whole lot. But XSP is really good, but what you will notice is that you run out of strikes very quickly. So unfortunately, you can't do a whole lot. You can't do all of your 0 DTE on just XSP. So that's really, if I had one complaint, I mean, it's just too bad we don't have mini futures for all of them, just so that a community with, reasonable size trading accounts can actually trade multiple 0 DTE strategies in the same day, in the same account, and not worry about that. You could just, once XSP is used up, you could go to something else like Nasdaq mini futures with 0 DTE. And then, IWM has a mini futures as well. That'd be good. But yeah, also remember that there are some times that it just matches up to 1 day or 0 days. You can do that as well. It doesn't have to be. There's only a few tickers that do 0 DTE, but sometimes it just matches up, like weeklies, and VXX has sometimes, sure, do it. Yeah, hopefully that gets you started. I'd say you can't go wrong with just double-sided verticals with stops on both. How could it go wrong? I'm assuming, sure, you could go on a coin-flipping terrible streak of bad luck, but very likely you'll have more that pin in the center than do the double stop out. Probably. That's how you make your money. All right. That was terrible. This is why I like to do full videos, plan out what I'm going to say. I'm not leaving anybody hanging, because what I said there probably has more follow-up questions than anything else. All right, that was way too long, but like I said, this isn't normal, usually long Q&As, but thanks for listening. Again, come back to it. I think there was some good information there. I love Iron Condors, and about half our community seems to hate them, half seem to like them. I'm hoping to change that. I think it's also recency bias, because they have not been doing well recently, and whenever that happens, people are like, oh, this is a garbage strategy. It's not making any money. True. It's not making any money. It's been flat for a little while, but that doesn't mean it's bad. Hopefully I can convince people of that. So thanks. We will see you next week. Remember, Monday's a holiday, so no email on Monday.